I cannot recall a time when even determining if the market is strengthening or weakening was this difficult. The S&P 500, the most important index in the world, has essentially gone nowhere for almost 2 months and was down again last week. The magnificent 7 stocks that led the market for so long have been very unmagnificent, collectively dropping almost 15% from their early May high after another 5% skid last week. The majority of S&P sectors have made no progress in months, and some breadth measures continue to make lower highs. If focusing just on these measures, it would be easy to assume that the stock market is heading in the wrong direction. And yet, a good case can just as easily be made that the rally has been broadening recently. The Dow Jones Industrial Average, the S&P 500 Equal Weighted Index, and the small cap Russell 2000 all made new all-time highs last week. The NYSE Advanced Decline Line did as well. It isn't that nothing has been working lately, it's just that the leadership has changed. Rotations continue to occur from day to day to help keep a high floor underneath even the indices that haven't been doing as well. Capital is not abandoning stocks altogether. It is seeking new opportunities. We are even witnessing this rotation occur within themes as well. It is no secret that the AI trade has helped propel the stock market higher over the past year. To just belabor this point on AI a bit further, it will be written about in future economic books as a phenomenon unlike any other in that it is expanding like a virus and gaining speed and strength at an accelerating rate. It will eventually reach a point where its importance will slow its advance, but we appear to be far from there at this point. The biggest, smartest, and most well-capitalized companies in the world are doing everything in their power by way of equity offerings and debt offerings to get the funds necessary to expand their personal investment for their own concerns. How can we measure the benefit of these investments when we don't completely understand how to even know what can be attributed to the AI investment and what is simply peripheral benefit? Again, it is an organic development that is very tough to quantify. Last week I spoke about how the markets have acted in the first 6 months of the year, taking into account the Iran war, midterm elections, presidential midterm year, and a new Federal Reserve chairman. So far, so good. This is not what the analog for second year of a presidential term has previously shown, but I think instead is reflective of the overriding effect of AI on the world. Since AI is like a form of COVID in how it has really spread and grown almost virally, it is clearly the 2026 version of the old saying, "It's different this time." If it is truly different this time, what could we expect going to the second half of the year? Thomas Lee upped his year-end targets last Thursday, as have many other analysts, to 8,000 for year-end. This is really the cards that I feel we are currently holding. In order to truly quantify this set of data points, I keep coming back to earnings, earnings, earnings. At the end of 2025, the general forecast for the earnings for 2026 for the S&P 500 was $309.28. As of June 18th, due to the gross beat by the majority of the companies in the index, this number has been raised to $340.82, and subsequently the forecasts for 2027 have been raised as well. Even though companies are making more money and the market is higher, the index is actually priced cheaper today than it was January 1st of this year. This basically says that the price of the market doesn't believe that the growth in earnings is going to continue, and therefore it is pricing in a slower rate of ascent. I say this as the stock market is a discounting mechanism. We listen to earnings reports which reflect the immediate past and then create forecasts of the future. Stock prices tend to reflect expectations 12 to 16 months forward. This is why it stands to reason that there could certainly be some type of correction. But it seems that staying invested should prove to be the best decision, given that the earnings and revenues continue to rise. Here is where the price to earnings ration measurement, PE, sits currently. I use the measure of PE as it is the most general way, historically, that people can attempt to compare apples to oranges. So, getting back to this general measure of price to the value of earnings, we really must scratch our head at this simple measure. How could this be? It really seems quite strange to me as a market participant. The overwhelming explanation for this utter spectral difference, I believe, lies in the media and concentration of the non-Trump commentaries. I know this sounds political, but it is not intended to be. I simply am saying, how could the US companies be raging, interest rates remain stable, gold, silver, and Bitcoin selling off dramatically, and labor and earnings be stable and growing, yet everything one reads is saying the everything is terrible? I believe this is explained in the polled consumer sentiment numbers. I say polled as a statement to the political bias of the people whose opinions are being reflected. Investors that aren't participating or have missed the advance are clearly upset. Those that continue to benefit say nothing as they are moving along happily. Last month, I gave the statistics of the percentage of those polled that are conservative or liberal. I believe that this explains a great part of it. Given that the media is telling a totally different story than the corporate earnings environment is, how has this looked relative to how it did around the dot-com bubble that burst in 2000? Well, as bizarro as it may seem, consumer confidence was at its highest ever in 2000, and today it is at its lowest reading ever. Strange but true. Here is the picture of the market's historical ascent overlaid on consumer confidence. Now remember the picture here and look at the time of the 7 black swans that have come home to roost since COVID. Clearly, the markets have figured out a way to deal with these unforeseen events and progress higher. Not only have the markets moved higher, but companies are collectively priced even cheaper than they were before any of these nasty situations. Again, this is truly a head-scratcher. But again, further testament that news sells based on negativity. But companies thrive because they figure out how to figure it out. I believe the growing optimism surrounding artificial intelligence is partially responsible for the rotation we've seen. That should be a good thing in the long run, although it might not come without some bumps along the way. The broadening out of the rally is obviously preferred to a coordinated pullback. The resilience has been impressive, especially as many of the largest companies in the market struggle. For years, the heavy concentration in the S&P 500 and NASDAQ 100 in a small number of mega-cap names has been a major talking point and a major risk. The fact that we've witnessed these stocks fall without taking the market down with them must be acknowledged. Should these stocks strengthen once again, it can also help push the SPX and NDX higher very quickly. Of course, on the flip side, it does leave the market more vulnerable in the event the recent leadership falters and there isn't enough strength in the big boys to make up for it. So far, that has not happened. I feel I am beating a dead horse at this point, but the clear rotation into AI beneficiaries makes the complete obliteration in commodities and commodity companies even more baffling. Unless all this AI infrastructure will be built out and powered with hopes and dreams, it's going to require a ton of resources. This is why I believe the market is broadening and more companies are participating. Summer tends to be a time of slower market movement, and this year has many other factors that also add to a market that could be a little stuck in the mud. What we can rest assured by is that the underlying indexes are healthy, and earnings of individual companies in many different industries are continuing to flourish. The head-scratcher is the analysis that market prices are higher and prices as compared to earnings are actually lower. When things come back to a more normal environment, this could very well happen at much higher price levels, but not without twists and turns sure to create anxiety for investors along the way. As always, please contact us if we may be of assistance.